Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is a short excerpt from the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Business cycles, their reasons and their implications. So friends, in the trend analysis, what we discussed was a 100-year-long period of GDP numbers, right? We took an example where we were plotting an imaginary 100-year GDP number of a nation. And what happened is we found that in this example, the trend line, that is the long-term line which passes across all these decades, has a predictable trend. But there is a waviness in the short term to it. So we zoomed in one section, and this section showed some waviness here. Now business cycle is basically this particular waviness. This particular waviness you can call as business cycle. Now what is this business cycle and why does it occur in the first place? So friends, in the markets there are various factors. There are various factors like population, like monetary policy, fiscal policy, geopolitics, bank credit, supply and demand, consumption, capital expenses, technological developments, behavioral cycles of people. All these things are there which combine together and give us this waviness. And this waviness we term it as a business cycle. Now this business cycle has inherent factors also and external factors also influencing it. So what are the external factors? External factors are factors like geopolitics, global economy, technological developments or technological breakthroughs, policy changes, natural happenings, etc. etc. These are external factors. And they come along with certain cyclicalities which are a combination of both external and inherent factors. So there is the currency and monetary cycle, for example. Now when the markets are going through tough times, monetary intervention is done. Quantitative easing, for example, was a monetary intervention. Low interest rates, negative interest rates, zero interest rates was another kind of monetary intervention. Then when the inflation rates went up recently up to 7%, 8% in USA, the interest rates were notched up. This was another kind of monetary intervention. So this was a policy matter combined with the inherent characteristic of the cycle. Basically the cycle was exhibiting high inflation, so the policy had to intervene and reduce the inflation or take action to reduce the inflation, which caused the monetary cycle. The monetary cycle was basically a zero interest rate period followed by high interest rates. So this is currency cycle or monetary cycle. Then comes fiscal cycle. Again, due to certain reasons, if the markets inherently seem to slow down, then the government may think of reducing taxes or the government may think of increasing its spendings. So this again causes the fiscal cycle. Then comes the credit cycle. Credit cycle is basically banks expanding and rationalizing their balance sheets in a cyclical manner. Let's say when the markets are going through good times or smoother times, then the banks expand their balance sheets. Ideas are invested upon, consumption is invested upon, education is invested upon, infrastructure is invested upon, businesses are invested upon, individuals are invested upon. Like this, the balance sheet of banks expand. Then after a certain period of time, it can be 10 years, 15 years or whatever, then the banks see that certain ideas, certain individuals, certain businesses are not performing to the extent that was expected. So loans turn bad, that is non-performing assets accumulate. And when this number goes up to a certain threshold limit, then the banks think that we have to rationalize the balance sheet. Then again a rationalization period happens when the banks reduce their credit expansion or contract their credit expansion, right? This kind of behavior happens in a cyclical manner. This is again a combination of inherent patterns of requirement for loans, and which is followed by non-performance of loans which has to be rationalized. This is another credit cycle. Then comes supply and demand cycle. Customers buy different kinds of products. Some are durable products, some are consumable products, some are required on a recurring way, some are required once in a way, right? Like real estate is like once or twice in a lifetime kind of a purchase. Then electricity bills are a recurring cost. Gas bills are a recurring cost. Then a refrigerator is like a 3-year, 5-year or 7-year cost. So there are different cycles depending on different products, and hence supply and demand also goes through different cycles, and these cycles intermingle together to give what we call the supply and demand cycle, right? Which means different products and services go through different levels of demand cycles, and this demand cycle the supply side has to follow. So supply and demand both go in a cyclical manner, and as supply and demand keep on going in a cyclical manner, the capex also happens in a cyclical manner, because companies try to expand and eventually they may end up over expanding, and then they may have to rationalize. So this also creates capex cycle, that is a period when expansion happens, then a period when rationalization of this expanded capacity happens, which means you do not expand further, you just wait for the capacity utilization to go up to threshold limits. Then comes the behavioral cycles. Human beings behave in certain patterns. In certain ways, they react to the markets and their professional standings. So when things are going well, consumption happens in a much better level. But when things become tough, people start to rationalize their expenses, people become negative towards the markets, and all these together may lead to a cyclicality in what we see as the stock market cycle. Right? Stock market cycle seems to be the very evident or the extrovert portion of all these cycles that we talk about. Everything else can happen in a technical way, in a way in which the domain experts will know, but stock market cycles we all get to know. And this is basically the collective behaviors of people which is triggered by the actual scenarios in a lagged way or in a leading way are reflected in the market cycles, right? This is a reflection of the market's actual position combined with the behavioral response to that actual position. This is what we see as the stock market cycle. Then comes the competition cycle. Competition cycle, let's say a new technology develops, right? In the beginning, only 1 or 2 or 3 companies at max are developing that technology. Maybe artificial intelligence, maybe some other kind of technology, whatever. Now, during the initial stages, growth is very high, the margins are very high, there is huge amount of scalability in it. But then, with time, as more and more competition starts to happen in this technology, the industry matures, the competition increases, the profits get slashed. So this also creates a cyclicality where initially the growths are high, the margins are very high, then it may so happen that the margins are reduced and the growth is also hampered, or growth also becomes a matter of great competition. So this creates the competition cycle. Then the consumption cycle. We already spoke about the consumption cycle a little bit, but let me elaborate it once again. That people are buying different products which are required at different intervals of time. And these intervals combined with the economic scenario as a whole creates what we call the consumption cycle. These cyclicalities which are inherent to the markets combined with the external factors gives result to what we know as the business cycle. These combined give us the business cycle. Now this business cycle basically has certain phases. First some recovery happens, then expansion happens, then peaking of the expansion happens, then again slowdown happens followed by contraction. Again recovery happens, again expansion happens, again peaking happens, again slowdown and expansion happens. This happens in a cyclical way, although because the business cycle is a combination of multiple other cycles, like we spoke about a few cycles here, because this business cycle is a combination of multiple other cycles resulting in a business cycle, the cyclicality or the periodicity is not consistent. Sometimes it may happen in 8 years, 10 years, sometimes it may take 15 years, sometimes 20 years, sometimes less than 10 years, sometimes 5 or 6 years, etc., etc. This means that timing this cyclicality or understanding which phase of the cycle we are in currently is a much more difficult process. So let us try to understand what are the characteristics of the different phases of a business cycle. Phases of a business cycle. So friends, we have tried to draw a typical cycle here which consists of 5 of the following phases. So friends, here we have tried to create a picture of the phases of a typical business cycle. First, the business cycle begins with the initial recovery phase. Initial recovery happens. Then This is followed by the early expansion phase or the early very good times. Then the early expansion phase is followed by the late expansion phase, which has certain other characteristics. Late expansion phase is followed by a slowdown where growth actually stagnates or goes back to zero. Then that is followed by a phase which has negative growth. So here, if you want to understand what this vertical axis suggests, this actually suggests the growth. So the growth has a baseline of 0 here, and anything above this is positive growth, and anything below this is negative growth or degrowth. So this is what happens here, and the horizontal axis is obviously time. You can say this is time, right? Now the initial recovery, the early expansion, late expansion, slowdown and contraction. These phases have their unique characteristics at different levels. At the level of fixed income, at the level of bond markets, at the level of equity markets, at the level of asset prices, real asset prices, at the level of policies, everything is different. At the level of consumption, capital expense, everything is different. So all these factors and how they behave in each of these individual cycles, we will try to understand here. So these behaviors of individual phases of a business cycle we will understand here. So let's begin. So friends, we'll start with the initial recovery. What are their features in terms of consumption? What are the features in terms of capital markets? That is, what are the prices or what are the behaviors of different assets? These things we'll understand. So we have already said there are 5 phases here. So our first phase is initial recovery. Then there is early expansion. Then there is late expansion. Then there is a slowdown, and which is ultimately, unfortunately, followed by a contraction, right? So we will start with the first phase, which is the initial recovery phase. What happens here? First, the output gap is still negative. What do you mean by output gap? So what happens is expansion happens during expansion cycle, not only in consumption but also in business capacity building. Now this expansion can often overshoot the requirement during a slowdown or contraction. In fact, most probably it does. So what happens during a contraction phase is the consumption slows down and goes into negative growth territory, and the businesses in response delay their equipment purchases, delay their inventory purchases, and as a result there is a negative gap between demand and supply. So during the initial recovery, what happens is the demand picks up, but companies are yet to fill up their inventories adequately. The capacities are underutilized, and even sometimes capacity buildup is not there, right? So this is what creates this negative output gap. Then what happens? Inflation is still slowing down. So even though the economies are recovering, it may so happen that the inflation is still slowing down. It is not yet on the rise, right? Then spending begins on real estate and durables. So as I said, a real estate is a once in a while purchase and a very big ticket size purchase. One can only purchase this when the finances in the long term future are seeming to be certain, at least for the next 5 years or 10 years or whatever. These kind of purchases are generally made by individuals when their financial condition and outlook is generally stable. But during a contraction, what happens is the financial situation of individuals in a collective way becomes unstable, comparatively speaking, right? And as a result, what happens is people delay their real estate purchases. And so goes with their durable or consumer durable purchases. If there is an air conditioning to be bought, if a freezer is to be bought, if a car is to be bought, all these things also can get delayed during a contraction phase. And during the initial recovery phase, these purchases restart. So this is an indication of a initial recovery, friends. Then let us talk about the capital markets. What happens to the capital markets? During a contraction period, states usually ease the monetary policy, which means lower interest rates for a sustained period of time. Now, this can continue even during the initial recovery phase. Short-term interest rates may still be low. And what about the government bond yields? During a period of contraction, people take flight or people move their capital to safer assets. And government bond yield is generally considered to be a very, very safe asset. In fact, arguably the safest of assets. So what happens is the prices of government bonds go up, and as a result their yields come down. Now what happens during the initial recovery phase also is that the yields of government bonds remain low. They remain low, right? So government bond yields still remain low. Short-term rates, they also remain low because the policymakers want to be confirmed that the initial recovery phase has begun. So it is also happening in a lag. Now then, yields may continue to fall. Yields may continue to fall, which means people are still looking for safer assets, which means they are going for high quality bonds, and as a result, yields keep on falling because there is more purchase power going towards them. Then, what about the stock markets? The stock markets rise. This is a phase when the stock markets see rise in their levels. And particularly, we can see an uptick in the small caps, we can see an uptick in the cyclicals, or we can even see an uptick in the startup, venture funding, private equity and all that. So these are indications of initial recovery phase, right? Now, after the initial recovery phase, there is the next phase, which is the early expansion phase. What are the characteristics of that phase? Let's discuss that. So what are the features of an early expansion, friends? In early expansion, the output gap is still negative. It is still negative, but the gap is narrowing. Means people are buying their capacities and they're investing. Meaning people are investing in capex and people are also growing their inventories. So capex and inventory growth is happening during this time. Capex and inventory growth is happening. Output gap is still negative but narrowing down, right? So this is the first characteristic of early expansion phase. The profits start to rise. The profits are also now clearly rising. The performance numbers are going up. Then there is further uptake in real estate spendings and also in consumer durables. And what about the capital markets? In terms of capital markets, the short-term rates for the first time show signs of rising. That is, the central banks become aware that the early expansion phase has arrived, the recession is over, the contraction is over, and we are in early expansion phase. So some rationalization is required. So short-term rates are intervened upon and a little bit of increment is brought upon in that phase. Long-term rates are not touched, they remain stable. They are kept stable. So short-term rates are going up, long-term rates are stable. This means what? The yield curve is flattening. It was very steep during the early expansion phase. It was very steep. Now it has become a little flatter. The angle has reduced. That's all. But it's still steeper than what it is in a peak phase or a slowdown phase, right? What about the stocks? The stocks are actually rising. At all levels, the stocks are rising and trending upwards. Now, what happens during a late expansion phase? Let's understand that. So friends, in the late expansion phase, the first thing that is observed is output gap is no more there. The output gap is closed. That means capacities are utilized, capacity expansion is sufficient, inventories are sufficient. Then, not only that, there is actually chances of overheating in the markets. That is, capacities may have gone beyond the future demand, or people may be purchasing more than they require. They may be taking too much leverage than they can manage, etc., etc. There is a general euphoria in the markets. Debt levels rise, which means leverage is there at all levels, at corporation levels, at individual levels, even at the sovereign levels, debt levels may rise, which may increase the risks. And higher risks means higher volatility. So what happens in the capital markets, friends? In the capital markets, the short-term rates keep on rising because central bank knows that this is the late stage of expansion, which might be followed by a slowdown, which might again be followed by a contraction. So The rationalization is required, which means short-term rates have to rise. So short-term rates keep on rising, driven by central bank policies. The bond yields are also rising. So during late expansion phase, what happens is riskier assets, lot of funds get diverted to riskier assets. So the bond yields rise. But this rise is less slow than the short-term rates rise. So which means the yield continues to flatten further. So the yields continue to flatten because even though both long-term and short-term yields are rising, the long-term yields are rising slower than the short-term rates. So the curve becomes even flatter. Even flatter. So the angle reduces further. Right? Then what about the stocks? The stock markets are still rising. Often it is still rising, but with volatility, especially stocks which are small caps or cyclicals, they show higher volatility and underperform. Right? Now what about the slowdown phase? The late expansion phase gives way to the slowdown phase. What are the features of it? Let's discuss. So the slowdown phase features, what are they? Firstly, investment options are less. Fewer good ideas to be invested upon. That is the first thing. The leverage has accumulated a lot and there are high debt levels all across the board. Then there is high inflation. Inflation which started picking up during the late expansion itself continues to rise further. Therefore, costs rise, putting pressure on consumption. Capital markets. What about the capital markets? Short-term rates are still rising because central bank still wants to be sure that the central banks want to be sure that overeating and inflation spirals do not happen. So short-term rates are rising, but they might be nearing peak. Then bond yields go down. Bond yields go down because suddenly everybody is trying to invest in safer assets. High quality bonds qualify that criteria and people are putting their funds continuously in them, thereby reducing the bond yields. Which means yield curve may invert. Right? It can invert. Short-term rates may go upwards. Credit spreads widen. Obviously, because everything is taking flight towards higher qualities and consumption has gone down, business conditions and economic conditions have deteriorated, many of the debts have become riskier. So credit spreads have widened. Stocks may fall. Apart from a few very defensive sectors like utilities, other sectors may actually fall. Now, post this slowdown comes the phase of contraction or probable negative growth. What are the features of that phase? Let's discuss it. So during the contraction phase, there is uncertainty at all levels, right? Which means spendings go down. Production of businesses go down, they are reduced. Inventory levels are reduced, capacity utilizations are reduced, expansions are halted, equipment orders are postponed, and all these things happen. Profits start going down. Not only profits go down, losses may happen, bankruptcies may happen, frauds may become revealed, and all this happens during a correction phase very often. Unemployment rises because businesses are not able to sustain the costs. Unemployment generally may rise. What about the capital markets? Short-term rates, the central banks realize now is the time to start dropping them. So short-term rates start to drop. Then stock markets, obviously they also start to decline. And decline can be a very polite way of saying this. There can be a stock market crash also, right? Credit spreads widen and remain wide. So if there is a contraction happening, obviously consumption all across the board is coming down at all levels, which means servicing the debt has become much more riskier, much more uncertain. So credit spread widens and remains wide till the time signs are there that the recovery has started to happen. But at the end of the contraction phase, something happens with the stock market which is positive, which means the stock markets start to rise. Well before the actual economics start to develop or become healthier, the stock markets generally show signs of rising up once again. So these are the 5 phases of a typical business cycle. Now we'll move into the next section where we'll talk about the relationship between capital markets and business cycles, relationship between capital markets and inflation, relationship between inflation and business cycles, and all of that. So let's start.
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.